Hi guys, welcome back to The Baseline. Thanks again for joining me. Today we're going to be talking about the jobs report that shocked Wall Street and what's going to happen next. So stop scrolling, listen to this. The stock market just smashed through another record. And it wasn't because of AI hype or a celebrity meltdown or another billionaire rocket launch. No, this time it was because a single piece of paper called the jobs report just blindsided everybody on Wall Street. And tonight, we're going to try to break down exactly why this report turned the whole game upside down and what it means for your money, your mortgage, your job, and your summer vacation. So if you think you're not affected, think again, and we'll try to get that reality check up for you in this next episode here. So for the next few moments, we're going to try to have a few laughs, but before we crack this open, do me a favor. If you hear something that makes you go, wait, is that even true? Fact check me in the comment sections because I could be wrong and I learn from you guys too. So bring it on. Let's rip through this, okay? Now, here's the headline that jolted the market a bit today. And it jolted it in a way that made it awake like a double espresso shot, right? The U.S. labor market, the thing that economists have been saying is cooling down, slowing down, and maybe even tipping over, decided to do the exact opposite. So in June, the economy added 147,000 new jobs. And that might not sound insane at first, but here's the twist. Experts thought we'd barely squeak through 110,000. In Wall Street language, that's like betting on a C- and subtly pulling an A+. It jolts the stock market, the bond market, and your buddy's 401k. And it freaks out the people with the worst job in America, the Federal Reserve. So here's a refresher. The Federal Reserve is basically the financial babysitter. They're the ones adjusting interest rates, trying to keep inflation in check without tanking the economy all at once. So if the labor market weakens, that's their excuse to cut rates. Cheaper borrowing, mortgage relief, stocks go wild. But if the labor market flexes its muscles, surprise, the Fed has no excuse to slash those rates fast. So the sweet interest rate cut that everybody wanted in July, it just vanished like your leftover pizza when you're living with roommates. So this is interesting because before this report dropped, the odds of a July rate cut were floating around 26%, a decent coin toss for the optimists. After the report, that probability sank like my hopes every time I check my bank account after a brunch. It went all the way down to 4.7%. So if you were banking on your credit card APR dropping magically next month, sorry guys, but don't log off yet because there's more to this story than just July. So where did the jobs actually come from? All right, where did these surprising jobs even come from? Let's peek behind the curtain. The biggest engine, state and local governments. They piled on about 73,000 jobs. That's huge. That's your teachers, cities, fireworkers, county clerks, folks. That makes your local life tick. Second place was healthcare and social assistance. Makes sense. People keep needing doctors, nurses, and caregivers. Third was leisure and hospitality, hotels, restaurants, the places you blow your paycheck at. And manufacturing, sorry blue collars, you lost 7,000 jobs. So that stung. And that might sting more later if this trend sticks. So what's the layoff story? And here's the spicy part. While local governments were hiring, the federal government quietly trimmed its headcount. We're talking about 7,000 federal jobs gone in June, just alone, right? And it's all part of the bigger 5-month slide totaling about 66,000 job cuts. Severance pay, lawsuits, delayed pink slips, it's messy behind the scenes. But the point is, Washington is trimming while the states are bulking up. So which one do you think is sustainable? Now, that comes for this pop quiz, right? So everyone in the comments, do you think local governments can keep hiring like this forever? Or, spoiler, probably not, right? Local budgets get squeezed fast and tax revenue does slow. And when that happens, guess who stops adding jobs? Your city hall. So don't get too comfortable quite yet. And the real twist, here's the twist that people always seem to overlook, which is wages. Yeah, we added jobs, but at what pay? Wage growth clocked in at 3.7% lower than last year, lower than your Uber Eats bill inflation, lower than a lot of rent hikes. So while the official inflation rate has come down, your paychecks boost has come down too. Not exactly what we wanted. Ideally, you want wages holding strong while inflation cools. That's how you claw back what we lost during the price surge of 21 and 22. So a quick story, like I had a buddy of mine just got a 4% raise, super excited, right? Until he checked his rent, groceries, and car insurance. They all went up 10% in the same period. So that 4%, a nice pat on the back, but your wallet will still be crying. So drop a comment in the comment section below if you had the same joke played on you. But let's tackle the one thing people keep tweeting about, which is the unemployment rate. Now, the transcript said it dropped from 4.2 to 4.1, but let's get real. The latest numbers keep it hovering closer to about 4.0%, right? Just a straight 4. So technically, it's stable, maybe a slight uptick, but a slight drop, but no dramatic drop to brag about. Still 4% is historically low, and that means people are working, but how stable are those jobs? Now enter the Fed again. Back to the big players like Jerome Powell, the guy with the least enviable job in the country right now. He made it crystal clear at the recent hearing, if the labor market cracks in a scary way, they'll move fast to cut rates. But today, there is no sign of that crack. And at the recent ECB conference, Powell doubled down. We're watching the numbers, especially jobs, but unless we see real weakness, cuts are gonna wait. So July, off the table. September, maybe. So let's do some crystal ball work for the moment. Before the report, Wall Street did bet that there was a 96% chance the Fed would cut rates by September, but now that dropped to 71%. And still more likelier than not, but a lot less certain. So the translation, the stock market is okay with that for now, because the expectation is that eventually the cuts are still coming. Now, here's what most people miss. Markets don't hate bad news, they hate surprises. A hot jobs report, that's fine, as long as it doesn't drop out of nowhere. And the real risk is if next month suddenly reverses course and we're back to layoffs, and the Fed, they'll be reading every line of the next month's report like a thriller novel. Now, the Fed's cheat sheet here, this is kind of a fun fact that the Fed has its own little cheat sheet. It's called the Summary of Economic Projections, or SEP for the cool guys, right? They last updated it in June. 2 rate cuts still penciled in for 2024. So if they stick to that, you're looking at cuts in September, October, or December. But remember, the SEP can get tossed out the window in 5 seconds flat if the data says something otherwise. What does this mean for us? So all the fancy talk aside, what does this mean for you and me? Your mortgage rate is probably not dropping this month. Your credit cards are staying expensive, and your car loan is still going to be a bit painful. But if the economy cools off enough by late summer, you could see relief by Halloween or Christmas. Now, what's the reality check to all this and the risk of our recession? Because before we get excited about all this cheap money, here's the catch. Rate cuts only happen if the economy needs rescuing. That means more people out of work, more layoffs, more headlines about hiring freezes. So next time someone cheers for rate cuts, remind them cheap money means we're bailing somebody out. So what would be a soft landing versus a hard landing in this scenario? And you've heard a lot about that, right? Soft landings, the magical fairy tale where inflation drops, wages hold steady, growth slows just enough without throwing us into recession. It sounds awesome, right? But history says, we're terrible pilots. And sometimes the landing isn't soft. It's a nosedive. So buckle up, guys. It's going to be interesting. So here's our homework, right? We got to watch the next job report, watch the wage growth line, and does it flatten or fall? And let's watch unemployment. Does it creep above 4%? Because if two of those three tilt the wrong way, the Fed's going to cut. And here's the final pop and the final culture twist of this whole drama. And it reminds me of like every bad sequel. Wall Street wants the Fed to cut rates the same way Marvel wants to squeeze out another superhero flick. It works until it doesn't. And then the box office, it just bombs. So this is my take and what I'd probably do. If you're me, you stay nimble. Don't bet your wallet on a September cut. Watch your spending, watch your debt, and keep an eye on the headlines, not just on the clickbait ones. And for the love of all that's holy, double check your adjustable rate loans. All right, guys, that's the big picture. A stronger than expected jobs report, a confused Federal Reserve, a stock market pretending it's summer, it's summer break forever. And next month, we'll see if the script flips again. So drop a comment in the section below. Do you think the Fed will cut September rates? Or if you think they're going to keep dragging this out, tell me that too. And tell me, are you feeling more secure at work or worried about the pink slips that might be coming this fall? So thank you again so much for watching, guys. Hit that like and subscribe if you can. I would be so honored if you did that. And next week, we'll break into some hidden traps and corporate earnings seasons and all that kind of stuff. Anywho, guys, thanks again for watching The Baseline, and we'll catch you the next round. All right, cheers, everybody.